In the biological world, the cockroach is an evolutionary marvel. It's not pretty, nor is it particularly beloved. In fact, you'd probably try to kill it if you see one. Yet, it survives radiation, starvation, and the boot of the apex predator because it's engineered for one specific purpose: persistence. And in the frozen, hostile ecosystem of Canadian retail, that cockroach is Zellers. For the better part of a century, this discount department store was the aesthetic backdrop of the Canadian middle class. The place where you bought your first bicycle, your winter tires, and a pack of tube socks, all while smelling the distinct, greasy perfume of a diner fryer that hadn't been cleaned since the Mulrooney administration. It was never cool, nor was it high fashion. It was simply there, anchoring the far end of every dying mall from Nanaimo to Newfoundland. By every metric of modern capitalism, this brand should be 6 feet under, rotting alongside Eaton's and Sears. It's been liquidated, laughed at, and left for dead by the very people who were supposed to save it. It's been dragged to the edge of the abyss so many times that it should have fallen years ago. Yet Zellers has somehow clawed its way back to the surface. It's navigated a minefield that destroyed its competitors, outlasting economic recessions, changing consumer habits, and the implosion of the very industry it was built on. The story of Zellers is a brutal, bloody, and fascinating case study in brand psychology, real estate warfare, and the weaponization of nostalgia. A brand that was written off as a relic that has become the most interesting paradox in the business world. The most valuable asset Zellers possessed in the 1990s wasn't what you'd expect. It was the smell of deep fryer grease wafting from the back of the store. Indeed, for a massive percentage of the Canadian population, the Zellers brand was defined entirely by the Skillet. This in-store diner served as the anchor for the entire business, operating on a philosophy that modern retailers like Amazon and Walmart have aggressively engineered out of existence: dwell time. They understood the commercial value of loitering. The Skillet was a loss leader. The restaurant typically operated on razor-thin margins, selling a Big Z burger or a plate of fries and gravy for pocket change. The goal was never to profit from the food itself, rather the goal was to sedate the customer. A shopping trip to a discount department store can be a stressful, chaotic experience full of crying children and fluorescent glare. The restaurant offered a sanctuary. By allowing a family to sit in an orange vinyl booth and feed 4 people for under $20, Zellers relaxed the customer, and a relaxed and well-fed customer wanders the aisles slower and buys more than a stressed customer rushing to the exit. This specific brand of mass comfort was baked into the company's DNA by Walter P. Zeller. He acquired the chain in 1931, just as the Great Depression was dismantling the global economy. While competitors like Eaton's continued to chase the shrinking upper class with chandeliers and fine china, Zellers looked in the other direction. He set out to build a store for the millions, operating on the simple truth that the working class just wanted a respectable place to shop where the price tags didn't feel like an insult. By the 1980s, this ethos had evolved into a sophisticated data-gathering machine known as Club Z. Long before the internet allowed corporations to track cookies and mouse clicks, Zellers had mapped the consumption habits of the entire nation through a simple loyalty card. Club Z was arguably the most successful customer retention program in Canadian history.
Are you a Zellers customer? You are? Then welcome to Club Z, where
the best things in life are free.
You could earn some remarkable things.
Join Zellers Club Z and earn these incredible things and more just by shopping.
It weaponized sunk cost fallacy with a physical rewards catalog that arrived in the mail that gave a pathway to tangible goals such as a camping tent, a slow cooker, or a canoe. Shoppers became obsessively loyal to the chain, often ignoring lower prices at competitors like Kmart or Byway, simply to accumulate the points needed for a reward, effectively turning the act of purchasing toilet paper and socks into a game. Meanwhile, a fundamental shift was occurring in the boardroom that would eventually sign the company's death warrant. In 1978, the Hudson's Bay Company acquired Zellers. For decades, this arrangement functioned as a profitable symbiosis. The Bay was the prestige brand, selling perfumes and suits in downtown flagships, while Zellers was the relentless workhorse, churning out cash flow from the suburbs to subsidize the bay's overhead. The dynamic changed violently in the late 2000s with the arrival of NRDC equity partners led by Richard Baker. As a real estate tycoon by trade, Baker viewed the Zellers portfolio through a strictly asset-based lens. His team analyzed the balance sheet and discovered a massive opportunity where millions of square feet of prime undermonetized real estate were disguised as a department store. Zellers essentially sat on a hidden goldmine. Because the chain had expanded so aggressively during the mid-20th century, they held long-term and low-cost leases on the best anchor locations in almost every major shopping center in Canada. In the eyes of high finance, the concrete box itself is worth significantly more than the business operating inside it. The corporate strategy shifted away from selling more inventory and focused entirely on arbitraging these valuable leases. The financial pivot set the stage for the entrance of the primary antagonist, the American giant Target. By 2011, Target was hitting a wall. The company had completely saturated the United States and needed a new frontier to satisfy Wall Street's demand for growth. They looked north and saw a wealthy, English-speaking population that was already crossing the border in droves to shop at their store. Target executives viewed Canada as a sort of America light, assuming it was just a 51st state with a slightly higher tax rate and colder weather. But to expand into the Great White North, Target needed to overcome a logistical hurdle. Building 130 stores from scratch would require a decade of zoning hearings, construction delays, and land acquisition. They wanted a turnkey empire and wanted to invade instantly. This desire for speed aligned perfectly with Hudson Bay's desire for cash. In a deal that shook the retail world, Target agreed to pay $1.825 billion to Hudson's Bay to acquire the leasehold interests of up to 220 Zellers locations. The specifics of this deal are crucial. Target never actually bought Zellers. They didn't want the name, the merchandise, or the employees. They just wanted the keys to the buildings. Hudson's Bay effectively sold out their own store to pay their bills, sacrificing thousands of jobs for a quick payout. For the next 18 months, the Canadian public watched the slow-motion dismantling of a cultural icon. The everything must go signs plastered across the windows signaled a chaotic looting where fixtures were ripped from the walls and sold for scrap metal. The once pristine aisles became dumping grounds for unsold Cherokee brand denim and broken mannequins, while the Skillets served their final plates of fries before being gutted. While there was genuine sadness about losing the local Zellers, the consumer was simultaneously hypnotized by the promise of what was coming next. The media narrative promised that the Target experience would be chic, affordable, and distinctly American. The country convinced itself that trading Zellers for Target was an upgrade. They were wrong. This deal simply cleared the decks for the single greatest operational disaster in Canadian business history. The dismantling of Zellers might have been forgivable if the new tenant had actually succeeded, because capitalism is, after all, a system of creative destruction where the weak are replaced by the strong. However, what followed the eviction of Zellers was the single greatest operational disaster in the history of Canadian business. Target attempted to open 133 stores in a single year. For context, it took Walmart nearly 2 decades to build that kind of footprint in Canada. Target tried to do it in 12 months. The strategy was to take the old Zellers husks, slap a coat of white paint on the walls, and open the doors before the ink on the leases was dry. The rush to the finish line led to a catastrophic error in their supply chain. When Target took over, they refused to use the existing supply chain data from Zellers. They assumed that the Canadian system was obsolete and that their superior American algorithms would handle the job. They didn't realize that Canada is a logistical nightmare compared to the United States. The population is spread out over a landmass larger than China, with disparate pockets of density separated by thousands of kilometers of empty highway. Moving a truck from a distribution center in Cornwall to a store in St. John's involves variables that simply doesn't exist in the United States. The situation was compounded by a data migration failure that has become legendary in the IT world. We actually did a full deep dive into the specific mechanics of this disaster, and you can click the link on screen or in the description to watch that after this video. But the short version is this: Target couldn't keep the shelves stocked. The financial bleed was horrific, and Target hemorrhaged money at a rate that terrified its shareholders, losing $2 billion in less than 2 years. In 2015, they filed for creditor protection and fled the country, leaving behind 133 empty concrete shelves and thousands of unemployed workers. This retreat left a massive vacuum in the Canadian retail landscape. The middle market had effectively evaporated. At the bottom there was Walmart, which was chaotic and utilitarian, and at the top there was Hudson's Bay, which was expensive and confusing. But the comfortable middle, the place where a family could buy a toaster or a bra and a plate of fries in one trip, had vanished. Following the Target catastrophe, the Zellers brand entered a strange period of corporate purgatory. For 8 years, the trademark remained the property of the Hudson's Bay Company, locked in a vault like a family heirloom that no one knew how to display. HBC executives found themselves in a bind. They understood that the Zellers name still held immense power and nostalgia, particularly in a market that felt burned by American interlopers. However, they were terrified that if they let the trademark lapse, a competitor like Walmart or a private equity firm could snatch it up and use it against them. To prevent this, HBC engaged in a strategy known as defensive usage. They opened up a series of pop-up Zellers locations inside Hudson's Bay stores. These were legal maneuvers designed to satisfy the use it or lose it clauses of Canadian trademark law. These pop-ups usually consisted of nothing more than unsold clearance items shoved into a back corner marked by a flimsy vinyl banner. While this strategy satisfied the legal requirement to maintain the trademark, it damaged the brand's reputation with consumers. Then, desperate for a win and needing to drive foot traffic into their faltering department stores, HBC announced a massive relaunch in 2023. They planned to bring Zellers back to 25 locations across the country. When the doors finally opened in March 2023, shoppers found a sanitized 8,000 square foot corner carved out of a quiet Hudson's Bay. The appliances were missing, there was no diner, and the chaotic energy that defined the original Zellers experience had been completely scrubbed away. The merchandise mix further confused the issue with the wholesale introduction of a brand called Anko. HBC had signed an exclusive deal with Kmart Australia to bring their in-house label, Anko, to the Canadian market. Anko is a juggernaut in Australia, known for being cheap, trendy, and decent quality. But to a Canadian consumer expecting the return of domestic staples like Cherokee or Alfred Sung, the shelves felt foreign. The 2023 relaunch failed because it fundamentally misunderstood the assignment. The public didn't want a curated boutique experience inside a quiet department store. They wanted a true discount warehouse, akin to what they had back in the day. And while all of this is happening, the Hudson's Bay Company has been on life support, struggling in a ruthless market with forces beyond their control. In a desperate bid to stay solvent, the company had slowly cannibalized itself, selling their European operations, leveraging their real estate portfolio, and even letting go of their iconic flagship building on Queen Street in Toronto, leasing it back just to keep the lights on. By early 2025, the math has simply stopped working. The retail landscape had shifted permanently beneath their feet. Young shoppers migrated to the ultra-fast fashion of Shine and the convenience of Amazon, while older demographics shifted their loyalty to the bulk buying value of Costco. After years of asset sales, restructuring, and shrinking footprints, the final Hudson's Bay stores closed on June 1st, 2025, bringing an end to one of the longest retail chapters in Canadian history.
HBC will close all 80 of its stores, resulting in more than 8,000 people being laid off as of Sunday. In court documents filed yesterday, the liquidation sales will be completed by then.
However, in the wreckage of the bankruptcy court, liquidators discovered a strange anomaly. While the Hudson's Bay brand polled as tired and obsolete, the Zellers trademark still had a pulse. It possessed high engagement scores and a surprisingly robust presence on social media, where younger generations used the brand as a shorthand for retro cool. This value proposition attracted an unexpected buyer, Les Zellers de la Mode. For those outside of Quebec, Les Zellers was a legendary department store chain with its own turbulent history of reinvention. In August 2025, under aggressive new private ownership, they made the boldest bet in Canadian retail history, purchasing said Zellers trademark. This transaction marked the critical turning point in the saga. For the first time in 15 years, Zellers was no longer owned by a real estate holding company looking to strip its assets, nor was it tethered to a dying department store trying to protect its own image. The handcuffs were off, and Les Zellers immediately looked west to prove that the brand could stand on its own 2 feet. The owners wasted no time in diagnosing the previous failure. Les Zellers de la Mode understood immediately that the store-in-store concept was a dead end. For Zellers to succeed, it needed its own identity. In late August 2025, it was confirmed that Zellers was returning to Londonderry Mall in Edmonton as a full 60,000 square foot anchor tenant. The roadmap for 2026 reveals a strategy defined by aggressive patience. There's no attempt to colonize the entire map in 12 months. Instead, the rollout is methodical, ensuring that the supply chain can actually support the shelves before the doors unlock. And crucially for Zellers, the last decade of bankruptcies has littered the Canadian landscape with empty big box shelves. The collapse of Bed Bath & Beyond, the erasure of Sears, and the massive contraction of Hudson's Bay have left landlords desperate for tenants. Zellers is exploiting this desperation, securing leases for pennies on the dollar, making it that much easier for the brand to succeed in the future. The Cockroach has survived the nuclear winter and is now coming out swinging. And it turns out it's wearing a red polo shirt. But what do you think? Is this new Zellers just another nostalgia cash grab that will burn out in 2 years? Or have they finally found the model that works in the modern economy? And be honest, are you actually going to eat at the new diner? Or is the memory better than the reality? Let us know in the comments below, and I'm going to see if I can find a Zeddy Bear on eBay. Thanks for watching, and stay curious.